This is the Everything Financial Radio program. I'm your host, Dennis Tubbergen, and I am here every week at this time. Glad you tuned in. This is where we educate you about what's going on around the world, macroeconomically speaking, and how it might affect you and your money. It's all about education. We have a terrific program lined up for you today. We have Professor Laurence Kotlikoff back again. You may recall that Professor Kotlikoff, in addition to being a prolific author and professor at Boston University, has also served on the Council of Economic Advisors for both Presidents Reagan and Clinton. He's also served as a consultant for the International Monetary Fund, many central banks around the world. So we're very pleased to have Professor Kotlikoff back. We are also going to talk with him about a company that you may not know that he is involved in. He's actually president of a company that has been developing a software program to help folks maximize benefits from Social Security. There are thousands of potential options on how to collect your Social Security benefits, even if you're already collecting. And we'll talk with Professor Kotlikoff in today's third segment about those particular issues and how to avoid some potential mistakes. Also, a prominent economist this past week came out and said Japan is on the brink of disaster. Not only will I get Professor Kotlikoff's take on that momentarily, we'll also take a look at how this economist is predicting trade wars, and we'll look at really some of the eerie similarities as to what's going on today and what happened back in the 1930s, which was the last economic winter season. Also, mirroring a story that we talked about here about 3 weeks ago on the program, New Zealand this past week is looking to put together a deal with China, a trade deal that would allow New Zealand to bypass the U.S. dollar in trading with China. So we're seeing the U.S. dollar gradually lose prominence on the world stage as far as a reserve currency is concerned. We'll talk about what that might mean for you and your money, and what will it mean for the future of the U.S. dollar. We'll talk about that in today's second segment. And in the last segment of today's program, we'll ask the question, are financial markets addicted to money printing? What happens if this stimulus is pulled? What happens to financial markets, and what can you do to potentially protect yourself? So we have a terrific program lined up for you. Let me remind you, we do have our class, New Retirement Rules, which has been met very, very positively. So we've added another class for mid-June. You can go to newretirementrules.com to get more information or to register. The June class is filling up quickly and will likely reach capacity here over the next week. Again, newretirementrules.com to get more information. I'm pleased to have back on the program with me today Professor Laurence Kotlikoff. Professor Kotlikoff has a list of books that he's written that are very, very long. He has served as a consultant to the International Monetary Fund. He's testified before the U.S. Congress. He has a resume that if I were to list everything on the resume, we wouldn't have time to talk to him about what's going on around the world, financially and economically speaking. So, Professor, welcome back to the program. Glad you're here.
Yeah, my pleasure.
Professor, Japan has been making news this past week. The new prime minister there vowed to money print, if you will, and add liquidity to a system until 2% inflation was achieved. They are not close to achieving that, and yet we're seeing the yen devalue against other currencies quickly. There's talk of now trade tensions rising in Asia. So I have a two-part question for you. Ultimately, in your view, how will this policy play out? And then secondly, how will the rest of the world, particularly our listeners here in the United States, be affected?
They're printing a lot of money, and part of what's going on here is fiscal, that they have a huge official debt, something like 200% of GDP. They also have some official assets, which make the net debt probably more like 130% of GDP. But so at one level, what they're doing by printing money is just printing money, buying up government bonds that they'd otherwise have to pay principal plus interest on, and just making money by making money. And that relieves the taxpayer having to pay taxes to cover the interest and principal on the debt. But the expected outcome of this printing of money is, as you just indicated, inflation, or less deflation than would otherwise arise. And that takes a bite out of people's pockets, of the taxpayers' pockets, in a very indirect way, because the purchasing power of the money they already have and of the nominal bonds that they already own will go down. So even if you have less and less deflation, that means the purchasing power would otherwise have gone up by more, and you're having it go up by less. So it's really effectively a tax on the indirect tax on the public by printing money this way and buying bonds. Now, will it lead to inflation? Well, we've seen a lot of printing of money in the U.S. and a lot of hoarding of money by the banks in the U.S. in the form of excess reserves. So the money that's been printed in the U.S. hasn't really gotten out into the bloodstream of the economy and hasn't led prices to rise as rapidly as people might have expected. That could change on a dime. We could have the banks start printing out all the, lending out these excess reserves, the trillions in excess reserves are sitting on. And so we could have much more inflation in the U.S. Occur pretty quickly. Japan, it could also happen that way, that you have more inflation. You could have inflation take off. We certainly are seeing a big change in the exchange rates between the U.S. and Japan, and that means that the price of imported goods from the U.S. and other countries that are selling their goods in dollars, the prices internally in Japan for those goods are going to go up right away, or have gone up already. So, I don't see that printing money is actually a solution to any real problem that a country faces. If its prices were set too high, or its wages were set too high, if that was the reason Japan wasn't performing well, then you'd want to have people who are setting these prices lower the prices and get them in line. But to just try and inflate the economy to no particular purpose is not, to me, a real policy. If the country's got bills that it can't pay, it needs to cut its spending at the government level, not try and print money to pay its bills, in effect. That is not a responsible way to proceed. But the reality is that Japan has actually been growing pretty well on a per capita basis. Its growth rate on a per capita basis, a per person basis, is better than that has been as good in the last decade as in the U.S. So the reason the economy of Japan in total, in absolute terms, has not been rising as rapidly as it had in let's say the 70s and the 80s and the 60s, is because there's a big demographic change in Japan. Their population is actually shrinking thanks to the very low fertility rate that they've had for decades now. So you would expect the economy to get smaller just because they have smaller, fewer people. That tendency of fewer people is going to lead to a smaller economy is there, but there's also some productivity growth. And on balance, they're having some absolute growth, but it's not as big as in other countries. But people should not misread that to think the economy is in bad shape. If you look 50 years from now, Japan may have 20% fewer people, but much less crowded subways and cities, a much higher way of life because of less crowding and congestion and pollution. And it's a choice they've decided to make, at least for the moment, to have very low fertility. So Japan's doing okay. I don't see that they're in desperate shape, and that why the central bank needs to start printing money out the wazoo in order to fix a problem that's not there. The real problem they face is the fiscal one, which is paying for all the commitments to the elderly that they have and for their other public expenditures. And they seem to have a huge long-term fiscal problem, just like we do in the U.S., much bigger than the official debt really reflects, because they have big pension obligations that are off the books and healthcare obligations that are off the books, like we do. So they have to get about fixing those problems. They really can't print money to pay all those bills because they will end up with hyperinflation. So that would be a really bad outcome. So I think they're playing with fire. I don't think they're doing what we're doing, which is not addressing our fiscal realities and just postponing the problem and making it worse because of the postponement.
Professor, we have just 2 minutes left in this segment, and let me ask you this. The Wall Street Journal reported about a week ago that worldwide debt is $223 trillion, which is 313% of global GDP. Given these facts and given your explanation to the Japan question, which was terrific and detailed, doesn't a major asset repricing have to occur either through deflation or inflation to try to get debt levels back to a more manageable level?
Well, you could wipe out the U.S. Debt that's in the hands of the public, which is about $12 trillion, and we would still have a nation whose government is entirely broke, because most of our debts are, in effect, inflation indexed. If you look at the Social Security benefits that have been promised, they're explicitly, legally, formally indexed to inflation. The health care benefits, well, you can't inflate your way out of doctor bills and costs of MRIs. So those things are going to go up with inflation. Paying soldiers in the military, their salaries are going to keep even with inflation. So inflation is not really an answer. An answer is real reform, structural reform of the kind that I've written about at a website called thepurpleplans.org, thepurpleplans.org, which lays out plans for fixing our fundamental problems: Social Security, health care, taxes, the banking system, and some other problems, energy and education. So we need to think out of the box. We need to come up with solutions that appeal to the red and the blues, the Republicans and the Democrats, and that's why these purple plans, which are a mixture of red and blue, come to are the right answers, and they're very different from anything the politicians are now discussing or suggesting.
All right. Well, Professor, we're going to pick it up here in the next segment if we could, and I'd encourage everybody to go to the website, thepurpleplans.org, and Everything Financial Radio will return after these words. Stay with us.